What's up, people? Kenneth here, 100 Years of Wealth, streamhomeloan.com. Go ahead, smash the like button, hit subscribe. Let's keep this ball rolling. Be inspired by what I'm doing because I'm going to keep pushing to the top and watch me grow this channel, just by sticking to the script. This video is about how do you get a home loan with low or bad credit. I don't like to use the term bad, but how would you get a home loan if you have bad credit scores, or low credit scores, bad credit, whatever it is. There are options out there, right? And right now the options are pretty limited because in the past, when there was a whole market called subprime, where you had loans really geared towards people with credit scores below 600 down to 500 credit score. I'm not sure if there was anything that was lower because I never did any loans for anyone with a credit score less than 500. But there may have been options out there at that time back in 2000s up to 2008 when we had the big meltdown in the mortgage industry. For those that don't know, in 2008, the big recession was sparked by, defaulting mortgage loans that were basically given to clients with lower credit scores, limited documentation, limited income documentation, just not really having stringent guidelines and really thinking forward enough, just really kind of operating within the time and just being ultra flexible. That led to a massive foreclosure market. But that was really, the base of that was really a subprime lending market. That term isn't even used anymore. I don't have any lenders that hit me up and say, hey, we have subprime products now. But there are flexible programs out there. But most of them, outside of the one I'm going to speak on, that still operates and still gives you options within that lower credit score range, most programs out there are going to limit you to at least a 640 credit score. Some scenarios I see lenders allowing 620, things like that, which 620 is a fairly below average credit score, I guess you can call it. So that's still a lender, in my mind, being pretty flexible if they're allowing a 620 credit score. But 640 has been the new conventional standard that I've seen most lenders operate with. Now, like the video said, how do you get a loan with, how do you get a home loan with lower credit scores? The only option that I am currently aware of, this is 2022, we're in, the start of the second half of the year, early July. The only loan options that I am aware of for people that have credit scores in the 500s is going to be an FHA loan, Federal Housing Administration. I made a video before, it's not authority, FHA, correct me if I'm wrong on that. But I made a video before kind of giving you a little detail on who FHA is and where they started at and how they help buyers or homeowners with loan programs. But FHA right now is the only option that I know of that will help someone with a credit score below 600. There may be options out there, 580 and above. There may be. I'm not aware of it. And as a wholesale mortgage broker and lender, I'm aware of pretty much everything that's out there. But the reality of it is that there might be something that's some lenders offering where they're going a little bit below the normal minimums. But even then, FHA actually will allow you to go as low as a 500 credit score. Remember, at the end of the day, the lender that is doing the loan can still put an overlay on that and say, okay, FHA will allow for a 500 credit score, but I want to only lend down to 560 or 550. That's an overlay. So lenders still have that option, but obviously prior to your loan officer or me taking a client to one of those companies, I'm going to talk to the account executive. I'm going to confirm what their minimum FICO scores are and make sure I'm taking my client to the right place that fits for their scenario. But there are people that operate and they adhere directly to the guidelines, and they will allow you to go down to the minimum that FHA is allowing, which is the 500 number. So the difference is this: if you have a credit score 580 and above with FHA, they will allow you to put down 3.5% if you're purchasing a home. And if you're refinancing, they would allow you to go up to 96.5% as a rate and term transaction, meaning that you're just paying off the balance of the loan. So that's if your credit score is 580 and above. It's going to allow you to maximize and take full opportunity of what FHA, what their maximums are as far as loan to value. Now, if your credit score is on the lower half of that or the lower portion of that, 580 and below, all the way down to 500, you're going to be capped at 90% loan to value, meaning that you would have to either put 10% down if you were purchasing, or if you were trying to refinance, you would have to have at least 10% equity in the property in order to make it work with the credit score in between 500 to 580. So, besides just credit scores, there's other things that go into your credit that makes it, good, bad, however you want to categorize it. And that's going to be like your major derogatory history. Your major derogatory history, like, do you have a bankruptcy? Do you have a foreclosure in the past? Do you have any significant collections that are current and pending, things like that. And that's, it's going to vary in regards to what FHA will allow. And once again, correct me if I'm wrong, but the current, from what I've recently read, probably in the last 30 days, FHA will still allow you to, and with some lenders, obviously, some lenders are going to have overlays that are more restrictive, but a client can be 1 day out of bankruptcy, meaning that if your bankruptcy just discharged, actually completed, it's done, let's say for a Chapter 7 bankruptcy, once it's discharged and you're out of it, if you get an automated underwriting approval through the system, you can move forward if that lender doesn't have that overlay. So once again, always double check the guidelines because things do change, but that is a rule that FHA has had where you can be 1 day out of a bankruptcy. And if the lender is okay with that, they will allow you to refinance as long as you get that automated underwriting approval. Remember, with FHA, you're going to be required to get an AUS approval through DU, which is Desktop Underwriter. So that system takes in compensating factors. It's not just, do you meet the exact guidelines? In certain scenarios, if you don't get that automated approval, you can go with what's called a manual underwrite, where you do compare your application directly to the underwriting guidelines and see if your scenario works. And sometimes you can manually underwrite the file. A lot of times it's tough because the reason why a lot of people will go with FHA is because FHA is more flexible on debt ratio. But the moment you try to adhere to the manual guidelines, your debt ratio maximums are significantly less, and it's just like a thing that doesn't always balance out. But keep that in mind. But FHA, when you say like lower credit scores or bad credit, they're going to look at your collections. FHA, to my current knowledge, is okay with certain collections, right? If you had a credit card that was charged off, or you went delinquent on it and it's in collections and they're trying to collect on it, they're not necessarily going to ask you to pay that. An underwriter at a lender could possibly throw an overlay there and say, we want collections paid. That would be up to your loan officer to find a lender that is adhering directly to the guidelines, where it's, you don't have to pay these collections off. And that's also going to be dependent on the automated underwriting approval, right? When you run the automated approval, it'll tell you if there's something that's being required to be paid off. My recent and current knowledge for FHA is that most collections that don't pose a threat to turn into a lien on the property are not going to be required to be paid off. I actually did a scenario for a client many years ago, and he had some student loans that were discharged. And they may have actually still been in collections, but the whole thing was that, or were they discharged? I think that they were just in collections, but the thing was that they didn't pose a threat to become a lien against the property in the eyes of the underwriter, so they allowed it. They allowed us to close a transaction even knowing that the client had some student loans that were in collections. Because there's, that's really the concern for the lender. They are concerned if there is some sort of liability that could turn into a judgment that gets attached to your property. Most scenarios, a liability isn't going to turn into a lien on your property unless it was some sort of like a second mortgage or some sort of like loan that property was used as the collateral, or maybe a mechanic's lien or something like that. That's totally different. But that's really the lender's concern, and that's where that comes from. So you might have a scenario where a person has a 550 credit score. They have a few $1,000s in collections, or sometimes even more, and they're still able to get the loan approved. So that's really what I wanted to point out with this video, is that you can get a loan while not having perfect credit. I think mortgage institutions kind of look at it like, someone might not pay their credit card, which isn't a good thing, but that person is likely paying their rent or the things that, the must-haves, right? So they can kind of justify sometimes that, okay, if they might have slipped up on this credit card because of whatever reasons, it doesn't necessarily mean that they won't make their mortgage payment if we're looking at other factors and we can see that they have the ability to afford it. Just because you can qualify with bad credit doesn't mean you should, right? The reason why I say that is because even though we like to, kind of feel like, all right, that collection was a mistake that I made, or, it just didn't work out at that time, or whatever the case is, it is a reflection of where we're at with our responsibility, how we're taking care of our finances. Are we signing up for things that we will eventually not be able to afford in the short term? Things like that. So just because you can qualify for a loan with a 550 credit score and, a bunch of collections doesn't mean that you should, right? And I say that in the sense that it might be better for you to, mature a little within your payment history, mature a little within, handling your collections and, or whatever accounts that you have that have gone bad, getting those taken care of. Now, some could look at the strategy of like, well, no, I don't want to do that because then I'm gonna have to wait longer to buy this house. I know that I can afford this payment. I'm ready to go. I totally get that too. I totally get that because, like we said, someone can make a mistake on a credit card for whatever reason and not have really intended on doing that, and made some corrective behaviors where in their next situation, that's not even a concern of theirs. They're not gonna make that mistake again. But I think for a lot of scenarios, when you really look at it, the fact that 6 months ago you were having trouble paying your credit card, but now you're ready to buy a house, it might be reflective of impulsive activity. You might jump into something where you don't put yourself in a position to have long enough, reserves. It's just one of those things where like credit scores are there for a reason. I think that they do, to a certain degree, reflect your ability to repay things. But at the same time, lenders are taking that all into consideration as well. So obviously FHA has deemed that a 500 credit score doesn't necessarily mean that you cannot afford to make your mortgage payment, right? And that you won't, so they obviously in their calculations have seen enough people with credit scores like that continue to make their mortgage to where they feel like it's a worthy risk. So I'm with that. I understand that perspective too. I'm more talking about like the personal side of it, where it's like, hey, look, there was a time for me where I was like still kind of like getting my credit together, and it was just kind of reflective of like a little bit of irresponsibility, not paying attention to certain things, and just kind of like not having credit prioritized. And then, there was a shift where I just started really focusing on that, spent some time getting my credit together, taking care of the little outstanding accounts that were there, cleaning up the things that were owed, disputing a bunch of things that, weren't accurate, to the point where credit is completely clean, no issues at all, was able to purchase my house, was able to refinance and do what I needed to do. And once again, not to say that the person with a lower credit score couldn't do the same thing. I just think that the reality of it is that from a lender's perspective, your credit score does indicate at least your recent history of how you take care of your finances. So I would say, if you can make it happen and you can afford your mortgage payment, even with a lower credit score, go forward. Put yourself in a position to gain equity, stop paying rent, etc. But make sure you're just really considering, your monthly expenses and your ability to stay on track with that. And not just jumping into a situation because you're able to qualify, because that's what happened in 2008. A lot of people jumped into situations because the lenders were super flexible on guidelines. The lenders were, they had turned the notch of flexibility all the way up. You could have a 660 credit score or even lower and literally state your income. Just basically say, yeah, I make $10,000 a month, I make $20,000 a month. Didn't even matter what type of employment you were in. You could literally work at Jack in the Box. They might ask, are you a manager or not? But it was very, very flexible, to say the least, and almost like irresponsible to a certain degree, where of course people are going to say, hey, you know what, if I qualify for that, I'm going to jump on it and take advantage of it. But as soon as something changed for a lot of people, it wasn't a scenario that they could afford. So just consider that. Even if you are able to qualify at a lower credit score, are you ready to purchase? If so, more power to you. Get in there, make your payments, build your credit, and gain that equity. Do some renovations to the house, increase the value, and take advantage of that. And at the same time, I'm sure your credit scores will continue to improve over time, because you're now going to have a mortgage on your account or on your credit history. You're making those payments, etc. But main point is that you can qualify for a home loan with lower credit scores. Only route I know of right now is going to be FHA, like your traditional FHA program. Some lenders will allow you to go down to the FHA minimum of 500. Anything below 580 is going to require a 10% down payment, and anything above 580 will allow you, or 580 and above will allow you the ability to put down as little as 3.5%. There are a lot of down payment assistance programs out there that attach to FHA that will give you that 3.5%. So once again, FHA is a very flexible program. You can get into a home. Text in the comments if you have any questions, shoot me a DM, like and subscribe if you got some value from this, and have an excellent day.